Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 280 for November 9th, 2020. We are recording this at 1 p.m. Eastern Time. My name is David Kosmeter. I'm the creator of TimingResearch.com, and you should be seeing the Option Professor's screen right now. And obviously, we've had a interesting few days for news. And the Option Professor is here to talk to you about what he's seeing in the markets and what he is expecting for this week. So go ahead and turn it over to him.
Okay, thanks, David, and welcome everybody. Nice to have you all with us. Quick background on the Option Professor. Been in the business for decades and decades. Graduate of Boston College, went to some graduate school work over at UCLA, and conducted seminars throughout the nation. Thousands of investors have gone, and so I'm well versed on all different types of investments, and I'll cover a lot of them here this morning, so you can get an idea of what's going on price-wise in just about everything you'd be looking at, from stocks to bonds to commodities, etc. Okay, and then like I say, at the end of the broadcast, we'll explain how you could get a weekly update from us free of charge by simply going to the website and submitting your email address, and then bam, it comes to your email box every single day. We're proud of what we put out this year, from the bottom of the March, actually through the decline from February through the advance that we're seeing here today. So let's get right to it. S&P, first of all, what's going on in the news? The news, we have the Pfizer drug that's supposed to be the cure-all or get everybody back into the malls, et cetera. But Pfizer did say that it may not be that pervasively ready or something. They tempered the enthusiasm a bit. But that hasn't halted the buying spree that's gone on. Anytime you see the market go up like this or go down like it has sometimes, with heavy, 4 times, 5 times, 10 times normal volume, either up or down. The one thing you got to remember is there's got to be a seller for every buyer, right? So if you are on the sell side of this market today and you see the volume coming in like that, what would you do with your offer? In other words, you're going to be the offer when you're the seller, and the guys coming in with all this buying, they're going to be the bid. So you see a Mack truck coming at you with buy orders. Do you think you're going to raise the price as high as possible and take in that Mack truck of volume, knowing fully well that once that Mack truck is emptied, there may not be Mack trucks behind it, which means what? If you have a tremendous volume like this and you soar the prices up 3, 4, 5, sometimes 10, 20% on some of these stocks, and then you take in all that volume, so you sell it to everybody at these prices. Again, if there's not another Mack truck of volume behind it, sometimes the market can fall under its own weight. So you got to be a little careful buying into a tremendous up move. Obviously, you should have already had your ducks in the pond. Something we talked about for 6 months is that the value trade is going to work. And while it's not working every day, you're getting paid 3 and 3.5%, 4% dividend. So it was a no-brainer to us that the value play was the way to go. Because once we get the vaccine and once everybody gets back in the malls, all those things that have not made a move, like your what? Your banks, like your industrials, like your materials, like all that stuff, right? Like your epicenter stocks, right? They are going to roar, and today they're roaring. So this is of no surprise to us because we know that the difference between value and growth was ridiculous, off the chart, which means just like silver to gold ratio, when it gets to 120, you might want to get some silver instead of gold, right? And all of a sudden, silver goes from $10 to $30, while gold goes up 50%. Silver goes up 300%. You get it? So same thing today. You're not getting that much action out of tech, and you're not getting that much action out of a lot of stuff, but you're getting a lot of action out of value because the differential between value and growth was off the chart ridiculous. And all it was waiting for was the V word, vaccine. Okay? Now, it may be having a big day here, and sometimes after a big day, you might get a pullback. So right now, we know that the S&P today, let's see what it has hit today. The high today has been 3668. Well, we've already shaved 58 points off the market. So, I mean, you understand what I'm talking about? You go chasing a big up move volume day like today, and if you ended up buying the high on the S&P today, you're down 58 points on the S&P, and it's not even hardly lunchtime. So again, the likelihood of maybe pulling back towards the breakout point, which is your 3550, 3580 area, is certainly not off the charts. Now, do I think we're breaking 3,200 where we pulled back? Right now, there's no evidence of that. The only way that could happen, in my view, is the vaccine really is delayed and the COVID cases turn into hospitalizations and deaths. If the COVID cases turn into hospitalizations and death, then all bets are off on this rally, because then a lockdown of some type could be coming, and then it's back in the bottle for the genie. So again, that's your risk, is that the COVID cases, and of course the stimulus, when and if they come out with it, if it's not 2 trillion or 3 trillion, but it's 500 grand, then of course you're going to have trouble too. So those are the two things that are biggest risk to the market right now. Is A, the COVID thing turns south as far as hospitalizations and deaths, and the second big risk is the stimulus package can't get going because the guys in the Senate don't want it to go through. Okay, and then of course the third thing is Trump doesn't leave the White House, and all of a sudden, you need to get the National Guard to get him on the moving ban. So that's the other thing. But since Kushner and his daughter are saying, let's call it a day here, and he's filing the lawsuits, which look like junk lawsuits because he has no proof as far as we've seen. Maybe an isolated incident here or there, but not enough to change 7 states. And then, of course, if you're disputing the 7 states that you lost, and there's voter fraud alleged, why not go all 50 states? I mean, you can't just pick the ones you lost and say, hey, those are fraudulent, but the ones I won aren't. You know what I'm trying to say? So there's so many there's more holes in the story than Swiss cheese at this point, unless they fill it in with some factual information. And if they do that, that's another game changer. But right now, it does look like they're going to toss those things like they toss balls at cornhole or something like that. All right, here we go. S&P right there. So you can see big breakout, getting far away from the moving averages. That's always a little bit concerning, right? We went way above it up here, and it comes back down. Got way above it up here, comes back down. Way above it over here, come back down. So again, when you get up towards 3,700, which we did today, 3668, and you are having the volume that we heard today, because that's using up some gasoline, that volume is obviously done now. Now you've got to be a little concerned about a pullback. But again, the story has flipped in that the value story seems like it's got its legs finally. I'll give you an example of a value ETF. This is a Vanguard S&P 500 value ETF, okay? And this is something that we've been following and obviously we believe in. Now this pays just under a little bit under 3% dividend. And as you can see, every 105 to 115 was where we're accumulating. We're accumulating. Why? Because we think it's going to pop. Why? Because the valuation to growth is too ridiculous. And the stocks in there are all, named stocks that you would know, but you'd know also because they're banks and things like that, that they haven't moved yet. Okay, but that's clearly looking like a breakout. And look at the longer term of it. This is a 5-year graph. There's a lot of room. This is the 52-week high. You know how far above the NASDAQ is of its last year's 52-week high, or this year's 52-week high? It's way past it. So this stuff is just turning here. This is the breakout above 115. And again, the moving averages are pointing up, but there's a gap there. And would I be surprised if it has a dip? Absolutely not. If it has a dip, would I view it as a buy? Absolutely. All right. So let's look at number 20. Again, I'm going to share you my opinions and my observations today. There's many others. Okay, here's going back 20 years. So, again, you get the idea that the blue line is still rising. That's your long-term moving average. And the only time it was ever violated was when? During the big drop in 2018, where we dropped 25%, but it didn't stay under it very long. And even here in 2020, we had our drop, but again, it got back above it. It's been choppy, but look, higher low, higher low, higher low, higher low, higher low, higher low. That's not something that wants to come down. Okay, so there you go. And again, we're still, even from here, you're a good about 10 bucks. You're a good 8% away from the highs. And again, this thing pays just under 3%. Another one that we've been keeping an eye on, and this is called a high dividend. And it pays 3.5 to 4% in that range. Gave me the wrong one. Hold on. Here we go. This is high dividend, okay? ETF. Now this thing's just taken off too. Now paying 3.5. Where are you going to get 3.5 in around? It's not easy to get. So here you go. And then it looks like it's going pretty good now, right? And where's your RSI? Let's check the RSI down here. Yeah, RSI is above 50. It's just getting through 50, which means possibly what? There's a lot of real estate above. So we are kind of believing in the value situation, and we're getting paid here today very handsomely. Again, can it pull back towards 85 or something like that? Sure. Do I think it's coming back under 75? Not unless the COVID turns very south. Okay. All right. Let's get back to some other stuff going on. So we see the S&P looks great. Let's look at the NASDAQ here. And see, let's look at the Qs. Everybody trades the Qs. Let's take a look at the Qs. Again, you got change coming in the White House, which I think people are welcoming, and then you've got the Senate still red, which puts coaster brakes on any of the crazy ideas that could come up that might be excessive. So that's really they call it a Goldilocks situation, because you've got somebody running the bank, which is the Senate, who's still got some conservativeness in it, and then you've got people in the blue who are running the show, who realize we have many citizens that don't own Apple and many citizens that still are out of work, like 10 million of them. So the bottom line is you got a little bit of a temper, a compassionate group, but not a group in the Senate that's just going to pass anything with a rubber stamp. And people are viewing that as very positive. Now, this thing obviously has been, this is a 20-year graph. So you can see even during the crash, it never broke the moving averages. That's why I like to look at long-term graphs. So rather than panicking out down here, you could see it was a clear buy. And all you had to do was buy here with your stop underneath 160, and you would have ridden it all the way back up and doubled your money almost, right? Right, that's on the Qs. On some of the other stocks in the Qs, you could obviously have done a lot better, like NVIDIA, et cetera, et cetera. So bottom line is that they still look good, but it does look, again, that it is still not taking out that 300 number, although some people think in December we are going to take it out because there's been a lot of option play on the December 300 calls. But right now, it still hasn't even taken out the all-time high here of 303. Again, it's not getting the same kind of move. Look at the move today. It's not even a quarter of a percent. So the people have plowed into value, and they said this stuff here has had its run, which it certainly has. Valuations have doubled on some of these companies, which means it's not been earnings that drove it up. It was valuations, and valuations can be fickle, particularly when the interest rate environment changes. And I'm going to show you in a minute that the bond market has dropped significantly, which means the cheap low interest money has changed, which means you've got to revalue the stocks that were based on low interest rates. One of the stocks groups that you have to take a look at because they were benefiting from extremely low interest rate valuations is tech. Okay, so, and growth. Okay, so take a look at that, and that'll give you an idea. Let's look at the shorter term here. Say you look at a 6-month situation. And again, back and forth lately, 260 to 300. That's the range. It's a wide range. Right now, it looks like a good deal, and that's why people are thinking it's going to take out the 300. Okay, but let's look at RSI. RSI is still very, a lot of room on the RSI, not terribly, overdone by any means. But it could be a deal where you make money in the Qs, but you make more money on the value looking forward because they're going to have their more discounted value. I mean, the P ratio on the value indexes might be 14, 15, 16%. P ratio on these tech stocks, they're off, they're high. Since we're looking at the Qs, why don't we look at NVIDIA and see what some of these things are doing? These are the high flyer ones, the ones that have gone through the roof. Let's see what they're doing. Yeah, they're not, they're having a little bit of a tougher time. NVIDIA is down 17. Of course, they're supposed to be involved in the consoles of the Sony PlayStation or something that's coming out. So that's supposed to be a big boost as we go into the end of the year. So you might want to look for an entry point here on the buy side. Qualcomm, totally knocking the cover off the ball. But today it is, hanging in there pretty good. But you'll see it took off. Okay, 130 to 146. Big gap there. Who's to say if it's going to fill? but the bottom line is definitely is on the upswing because of the 5Gs coming and people want to get into there. AVGO is Broadcom. That's another one for the 5G. And yeah, so again, the 5G plays are going, but Taiwan Semiconductor, Advanced Micro Devices, the semis, let's see what they're doing. We already know NVIDIA got hit by 17. Taiwan should probably be getting hit too. Let's see. Taiwan Semi, not much. That's hanging in there very good. And AMD, who just bought, went into a purchase to try to expand their menu a bit. They're hanging in there as well. So really, NVIDIA is the one giving it up the most. I'll show you one that we picked up last week, Teva. Healthcare is going to be a big deal. Drug prices going down. Sounds like generics are going to be something. So we looked at the $8 call for July of next year. $8 was in the money about by a point. Going for a couple of bucks, and it's good till June of 2021. So you got the rest of this year and half of next year for this thing to get into the thing. And could this thing fly under the right circumstances? Let's take a look. You can see right here, it looks like it's breaking out. And then again, what's the theme? The theme is that, generics, it's going to be one of the factors to bring prices down. Here's a 1-year graph. Looks pretty good there. How's that RSI looking? Going through 50. So this could be, obviously when you buy a call, you're taking a risk. You lose all the premium if it doesn't happen. But you got leverage and limited risk because you're leveraging 100 shares every time you buy a call, and you're only out the $200 or whatever you pay for the option. Look at the 5-year. And it hasn't really taken off yet, but once it gets above these lines, which comes in all around 10. So if you start seeing this thing trade 10, 11, and if you see it break above 15, it's going to be bye-bye birdie maybe. Let's take a look at the 20-year. All right, so here you got, this is what I like. You got a situation where it hits a low, comes up, comes back down, doesn't take out the low. On the time where it came down to the low here, it did not, on the RSI, come any way down. That's a divergence. So again, getting above 15 would be very, very good. And you're giving it almost, 8 months or so to happen. And that's a pretty good amount of time. So, Teva might be an interesting thing to keep an eye on. There could be some potential there. Obviously, it's still got a long-term downtrend ahead of it. So it may only be good for a move towards 10 to 15. But even 10 to 15 obviously would be good. But if you want to see if you could get a more larger move, longer term, you obviously got to get through these numbers here and get them turning. But, we found that interesting, so we thought we'd bring that to your attention. That's our opinion on that. Okay, so what are the big guys doing like Apple? Since we're in the tech area, the Qs, let's look at FANG. Oh, I don't want Alcoa. AAPL. Although Alcoa does look like a turn. Maybe we'll go back to that chart. Again, metals, industrial metal, right? Okay, yeah, 140 looks awfully lonely, doesn't it? Yeah, it looks awfully lonely. And let's look at it on the short run here. 6 month. Okay. All right. So again, I thought it would get down to the 100 to 95 area. It got down to 103. So it didn't really get into the zone that we were hoping for, which is 90 to 100. But, if you're dollar cost averaging, you could have picked up a little bit here. And now this one here is another line in the sand. And if it takes out 125, again, it does open the door for 140. And the RSI right now is at 58. So, RSI is above 50. You generally are going to see up moves, as long as it's not at 100 or something, because that's obviously when it's overbought. But that's not a bad RSI, and it's starting to look like it wants to go. You can clearly see here, if it started breaking under this 115 where these averages are, under 115, it may be going after this gap. So again, anybody who's fooling around with Apple, 115 would be about as far as I'd give it. again, they again have not been running up just on sales of iPhones. In fact, sales of iPhones in China was down 29% in the last report. Everyone's waiting to see if this i12 is worth it. Some people I talk to say it's not going to be worth it. Some people say 5G is not going to be worth it. If they're right, Apple's going to have a rough racket going a lot higher. If they're wrong, then there's a heck of a lot of recycling to be done, and that would be very, very positive for the stock. So again, a nice line in the sand right now looks like about 115. And if you take out 125, that would open the door to the other stuff. Okay, Facebook. Big pullback on Facebook the other day. I think it's back up now sharply, though. Yeah, I had a big pullback here down to 260. Obviously, that was not a bad place to take a shot because you had lows there. Now we've run up here to almost 300. Now we're pulling back a bit. And on a tape like we've got now, Facebook coming down $6 is kind of, it would be, well, it's still above this number here. These numbers here come in at about 285. So if we can hold this 285, that would be very nice. If not, that gap becomes the problem, and the gap can lead anywhere from 270 to 280. So if we hold 285, that would be a good deal. If we don't, you got to figure 270 to 280 is the next stop. And the RSI is probably above 50. Yeah, but not by much. RSI is 56. So you don't want the RSI underneath 50. You'd like it to see, as you can see, the market does pretty good when the RSI stays pretty much above 50. All right, next one up is, what do we got, Facebook? Google. Google was a bargain down there at about $1,400. And then it had a big run up here. So let's take it, their ads are doing pretty good. And yeah, so they're in a different shape because their valuation is very fair, very fair. And they're sitting on a ton of cash. So that's another good thing about Google. Okay, so anyway, with Google, you got the RSI right here coming in at around 69, is it? Yeah, 71. So it's getting a little bit ahead of itself, but we've got the highs today at about 1815. So right now, let's see if tomorrow we don't take out 1815, and if we don't take it out by the end of the week, it may want to come back and fool around with this gap down here, 1650 to 1700. Okay. And on a short-term basis, what does it look like on the 5-day? Yeah, the 5-day, if it breaks 1770, that would kind of turn that down a little bit here. And on the 1 month, again, it just had a big run-up. Yeah. So the red line comes in at around 1765. Looks like 1740 to 1760 would be the area where you'd want it to hold if you want to stay bullish in the short term. In the short term. Long term, let's look at a 20-year graph so you get an idea how far it can go. A 5-year. Yeah, you can see it came down to 1400. So if you have these charts, you can see that's where it would hold. So when the news, and then when you got a low, see the low surrounded by higher lows, you take your shot. So you take your shot at 1450 because it made a low, and there's your two lows higher. So you take a shot at 1450, your stop's under 1400, and you ride it. Now, when you get way up here, it's a little bit more dangerous because, as you can see, guys who bought that breakout had to go through that. Guys who buy this breakout, maybe they don't have to, but maybe they're going to have to go through a little bit of a dip. So Google looks pretty good. It's a little bit extended short term, but the bottom line is it's one of the better valued FANG stocks, and they've got a great story with all the stuff that they own in addition to Google. And again, a turn in the economy would be helpful to these guys for sure. You got Netflix. Let's hear it. Netflix. Now, if we're all going to be going back out to the movie theaters, maybe this thing is not going to be as profitable as it was. That looks like a triple high area. It's underneath the red line right now, so you'd like it to get back above if you could. 500. If it can get above 500 again, then it's back in the ball game. On a 6-month basis, let's see what it looks like. 500 look like the number there. Yeah, 500 is the number here too. So you get back above 500, that would be better. Otherwise, we're now dangerously close to falling underneath the support area here. And if that happens, you could go down. Don't forget, these guys have not been spending like they used to because of COVID. They weren't producing as much content, which means what? Their numbers probably were better because their expenditures were less. Once these guys start producing all those 9 million content, that costs money. And then, of course, that could affect their net bottom lines. Couple of story stocks today. Uber's going nuts because California did pass that situation for them. So obviously that was fabulous. 36, boom, boom, boom. Now obviously it's getting a little ahead of itself, but that was one to take a shot on and make a bet that they weren't going to get them. The slower moving one is Lyft. Still not a bad looking one, but not in the Uber field. I traveled internationally though, and Italy and stuff were not big on these guys at all because the cab companies obviously don't want them in there. Now, what's good about these guys, in my view, is they used to be very cheap. You could call them up and you could go a mile or 2 or 4 miles, and it would cost you $2 or $3 or something small. Now they're just as expensive as calling a cab. So I think their plan was we were going to go in low price. We'll kill the taxi business. When the taxi business gets killed, people will get used to calling us, and then we'll charge them taxi rates for what we're doing, and that's how we're going to get profitable. That seems to be what's gone on. And not a bad plan, because they had to go through what? A downswing while they were squeezing the taxi business out of business. And now that they've got market share and they've got the law on their side as far as their non-employees, now the stage is set for them to have higher revenues because they charge more, and having plenty of people who can drive for them. So that's a pretty good deal. Again, obviously a little bit ahead of itself here from the moving averages. RSI on a 6-month basis got to be 80 or so. What is it at? 77. So, it could keep going and going and going, but this is not the ideal time to get in as far as, where would you put your stop? Okay. The other thing was going is the pot stocks had a good time of it. Let's look at that because they got passed in a few states. I think they said 1 out of 3 people have legal pot in their neighborhood. So this is a ETF that has a whole bunch of them in there. Rather than playing pin the tail on the pot stock, you could use MJ as a ETF. And as you can see, gave you good formation. Up move, down move, doesn't take out the low, takes out 12, and that's the time it goes, right? Even actually takes out 1175 was your buy signal. So you had a good buy signal here. You should already be in. And there you go. Let's look at another one that did pretty good, which was gambling. And we picked up this DraftKings here last week. Let's see how things are going. Went down into the 30s. Anything in the 30s looked like value to us. Let's see what it looks like now. Yeah, 42. Nothing crazy, and still got a lot of work to do. But we thought anything in the 30s looked pretty good. And you get, when you buy it in the 30s, 38, 40, 36, you can put a stop here, and you can sleep. With at least the difference between your price and your stop is not that far. Of course, a stop doesn't give you a guarantee at that price, but at least it's something in the market. Now, like I say, downtown Las Vegas, there's a new hotel called Circa, CIRCA. And they have the largest sports book around. And it's a brand new hotel. They got theater seating. So it's like you go in there and you're like going into a movie theater because they've got the most enormous screen you've ever seen in your life. And again, sports gambling is getting more and more mainstream because these states need money. And DraftKings got a great brand name and they got a lot of good guys backing it. So it looks like something that would have a future. And again, it looks like that low at 34 is defendable. So other ones in this arena is Penn Gaming. And Penn Gaming is Penn National. Yeah, there you go. So Penn Gaming is, looking like it's trying to get going as well. Another one in this is Churchill Downs. Something surprised me. I just thought they were a racetrack, but I guess they got. But I guess they have a lot of stuff going as far as other gaming activity. I just thought it was where you I just thought it was where you get the, Kentucky Derby, but they're into other stuff as well. So here you go with Churchill Downs. And there you go. So that's off to the races here a little bit. That's a 5-day graph, but let's go back 6 months. And then, so there you go, looking pretty good. And there is a ETF for gaming that we follow. And that ETF, so it's a one-stop shop for gaming, is a BJK. And BJK gets you in there with a diversified portfolio of gaming. And BJK up 252. So that's why you get into a diversified gaming thing. Because why? Because you might pick the wrong gaming stock. Here you got a diversification. All right. And so you got the gaming, you got the pot stocks, and you got the Ubers. These are all coming off of the elections, because they had referendums that had to get passed. And so they did pretty good. Let's just see here. Let's look at some of these banks. The big ones, Bank of America. We've been all over the community banks as well as the big banks, and obviously we're getting paid here today. All they needed was a steepening yield curve, something that we talked about every week in our newsletter. The yield curve is steepening. It's the most since 2016. People are not going to loan money to the government for 1% interest on a 30-year instrument, not knowing what the currency is going to be worth in the next 30 years. It's not going to last. And when the economy picks up, the long rates are going to have to go up, and they are. So bottom line is when they steepen, these guys can make more money. And we thought that would happen, and it has happened, and that's, bam, why you go. Looking at the other big leader is JP Morgan. And, of course, that should be going through 105 easy right now, if not more. And because it was in the 90s, and, 117. Yeah, there you go. All right. So you get the idea. That's why it's going up, the steepening of the yield curve, something we brought to our readers day in and day out months ago. And that's why we've been interested in it from 90 to 96. And now this is a payday, not a time just to get started. With regards to the community banks, we were into this thing between 35 and 40. This is KRE, regional banks, in between 35 and 40, bringing it to your attention. And now it's at 48. So as you can see, why would it be into it? Here's 35, there's 40. That's your zone to get in if you believe what? What we said, which was the steepening yield curve will help the banks. And also we got stimulus coming. That'll help the banks in the regional basis. And so there you go. So that's look at those two things. Another area internationally that we look at is the emerging markets. I'm giving you a wide range of things that we keep an eye on to give you an idea of what you can learn in the weekly update. This is the ETF for emerging markets. And again, you got the dollar dropping, and that's why this stuff is roaring. Okay, so there you go. And this stuff was obviously a buy anywhere between 41 and 44, and now you're getting paid. Another one that we've looked at for the Chinese stocks, KWeb. Let's see how that's doing. China Internet. Now that's not doing so much, but it has broken out a bit. So it still looks pretty good. Pullbacks towards 74 would be interesting, or 70. But obviously it looks like the momentum, you got the, do we have RSI on it anymore? Let's jump a little RSI on here real quick. But obviously if you want exposure to the internet sector over there, that's a one-stop shop. Another one that people like over there, obviously, is Baba. They went down because the Ant deal got set back, and the Ant deal getting set back, ANT. They are basically combining Google and a pay system all in one. And again, Baba is still having some trouble, but it came down to 280, and 280 was so far a good place to take a look at it. You see these highs there, and you see that gap there. So you hit that high, you filled that gap, and that's why buying against 280 made sense. And now that it's above its moving average, that's a key now too. So we want it to stay, if you're in BABA, you want it to stay above 290. You would like it to stay above 290. Starts breaking under 290, 280, that opens up a new can of worms. And it could be telling you something more serious is happening over in China. With regards to Europe, December 10th, they're getting together over there with Christine Lagarde, ECB. So that could be something to keep an eye on. And these guys, the valuations in Europe are supposed to be dirt cheap. So, they're going after value because of the dirt cheap valuations compared to growth, and they're going after Europe. Okay, so there's how you get involved in Europe. Okay, and if you go back 5 years, it gives you a little better perspective. Moving a little slow today, but anyway, that is... There you go. Okay, so you can see, oh, this is small cap. Okay, small cap growth. They give me a different one. Okay, hold on one second here. All right. I'm going to turn over now to a couple of the commodity sectors because, again, why is this market going up so much? Again, let's just look at some of the things that would move it in the commodity sector. One would be the U.S. dollar. Dollar index for December. Let's go after the 6-month deal here. Yeah. All right, here's the 6-month look at the dollar, because in the last 6 months, a lot of action. All right. We've been watching the dollar. We thought it was peaking up here in the 104-100 area. Can you see once it broke 100, that was it for the dollar. There you go. And you know what happened? This is in, April, May. You notice during April, May, June, that's when the gold got going. That's when the silver got going. That's when the stocks really started to accelerate. Right. Because the dollar was dropping. Now, the dollar has gone basically flat as far as the moving averages, right around 93.50, plus or minus a little bit. Right now, it's at the 92 area. Our belief is 90 to 92 is major support. Now, like I say, the RSI is under 50. That's not good. The prices are under 93.50. That's not good. So the longer they stay under here, you open the door for another dollar drop. If it gets above 93.50 and the RSI gets above 50, and we watch this every week, I would be nervous about being long a lot of stock, and I would be nervous being long a lot of metals, because this stuff here, if it ends up not going down under 92 like everyone's betting, it actually goes to 93.50 and takes out 94.50 and maybe comes back to these lows here, which would be 96 ballpark, right? 96, 96.50. If we don't break down under 92.90 and it goes the other way, I would keep an eye on this because it will have an effect, I believe, on the metals and stocks and the euro. Because that's why in this period, stocks, gold, euro, up, right? Now it's going up again because it's underneath here and people are betting it's going to drop. But it still hasn't taken out those lows. And if it starts taking out this, all these people that have bet on stocks and gold and euro, they're going to have to flip around again. And so keep an eye on the U.S. dollar. I think it's very important. We have talked about the dollar. Now let's talk about that gold. Gold's having a tough day today. Down $90 last time I talked. Maybe it came back a little bit. Let's see. Nope, down 96. That's called a little bit of a tank job, right? Because this thing was looking okay. It was in a downtrend actually, and then it broke up for a little bit, but now it's underneath the averages. Gold being under 920 and 1900 and 1920 is not good. And let's look at your RSI. If it's under 50, that's not good. And that RSI is under 50. So gold right now is going to be trying to hang on for dear life around this 1800 area, which is right there. So you can see that high there, that high, that was the big breakout point. Looks like we could go to 1800. What did we do today so far? We've been as low as 1848. So we went down to 1850. Is there another leg down? Possibly, or it could hold in here. But you need to get it, if you want to be bullish on gold, as far as trying to make some money momentum-wise, You got to get back above 1920 because you can't get up here without it. Now, if you look at the long-term graphs, you'll notice that it is extended still. See? And this is a high point, and look how far it was away from the blue line. And it came down and chopped and got back to the blue line, okay? This thing's way above the blue line, and what? It hasn't taken out the high of 2,000. 2,100 ballpark has been the high, and now you've got the red line here at 1,700, and your other moving averages are way down here. So is it possible that a significant drop could happen in gold? It's a very crowded trade. Every other commercial is, to buy the gold in some way, shape, or form. And everyone is talking about 3,000, 2,500, 3,000 gold. So again, RSI on the long-term graph is still positive. So it is still a bull market. Let's not change our tune on that. It is a bull market. The question is, will you get an opportunity at 1,800 or 1,700? Will you get a big opportunity between 1,400 and 1,600? Will you? Only time will tell. If that dollar takes out 93.50, 94.50 and goes to 96, you will get it, in my view, in our view, opinion, you will get an opportunity. But, should you get rid of all your gold? Of course not. Because why? It is still a long-term bull market. But should you keep some powder dry? Maybe even hedge a little bit if you had leverage positions? It might not be a bad idea. We are very much familiar with hedging. We always bring it up, hedging. How do you hedge? You use collars, you use married puts, you use replacement trades, you use trimming. How do all things work? Just go to the website and put your email in and some type of contact information, and we can review the mechanics on how those strategies work. More than happy to do it. Okay, so there's your gold. Let's look at the silver. Well, let's look at GDX. Now, we've been in the gold for decades, so, it's like a permanent part of the portfolio. But we have not added up here. The reason we haven't added is we're looking to see if we get a better price. So far, so good. We ran it up to 45, 46. We haven't been able to take that out. It's still, around here. Now, again, if you took out 45 and you wanted to add, that might make sense. Or you might want to see if it comes back and test that 30 area. Or at least go down to the red line, which is 32, ballpark. Okay, but you can see it's a bull market. But again, even in a bull market, you have pullbacks sometimes. Right now, on a short-term basis, you definitely don't want this thing taking out 36. And it's at 38.66. We also look at the junior miners. They tend to have a little bit more octane because obviously they're more volatile, more thinly traded. And again, big blow off up here, great buy at 35, nice little double of your money almost, and then boom, coming back down. Same thing as GDX, only more so. Let's take a look at your silver. This is the one we were mostly keen on, and we are still mostly keen on. Why? Because we're going to do a little math here. What's gold at? We said 1855. And let's divide it by what the silver's going for. This is ballpark rough math. 23.75. Your gold to silver ratio is almost 80 to 1. Okay, that's still very excessive. When we were down here, when gold, it went to like over 100 to 1. So again, like value to growth, silver to gold. So we think there's a better value down here. And again, a big move up. Once it broke above 20, can you see that? This was all in. Even actually, we started at 19, 18.19. Once you broke above 18.90, that was your signal. And boy, did you get a good run. But it was up here, we were telling people it's overbought. And the RSI was very high. Where was the RSI? Yeah, the RSI was up here at almost 80. Okay, so what happens when you get overbought? You consolidate and pull back. That's where you do your hedging. Collar strategies. What else? Trimming. What else? Married puts. What else? Covered calls. Something. All right, so anyway, still love the silver long term, but would love to be able to buy it against the breakout point of 20. That would be fantastic. And you're only $3 away. So if that dollar does take off a little bit against everyone's common sense, then you could get the opportunity. If not, I love it when it's above 26. Let me show you why I can see 26 is you got to get on board. Hold on. Yeah, you see 26 has been the highs here? You close above 26, that's above this resistance, which is your former lows, right? And then you're above this high here. So you get above 26, then you ring the bell and you say, listen, it's not going down here. I better get in, get something going. Okay? But right now, it's on the defensive. And right now, if it takes out 23, going back down to 20 is not that far-fetched. So keep an eye on it. And again, it's probably going to be linked to that dollar. Certainly not having a good day today, down almost 10%, 7.5%. Stock-wise, what can you look on here? You got SIL. And SIL's done about 8%. And again, it tried to break out, coming back down. Had a good run up here. And now if we look at SILJ, which is the juniors, this is the one we favor. It's a speculative investment, silver, right? And it's an aggressive investment. So obviously turning it up a notch to get the juniors going, doesn't seem to be over the top. And the juniors are also, because they're juniors, they have a ability to possibly get taken over by the larger guys who want to get mines without going into the ground anew. They can buy existing reserves. Okay, so there you go on that. Okay, so that's the gold and silver for you. And here's one that we have been very keen on because we don't think the electric cars are going to come back as into the thing as fast. So this is energy stocks and energy itself. And this is an ETF on energy. And look at that. See, we loved it all down here under 40, right? Why? Because we think that the rig count is very low. We think the fracking industry has been damaged. And so we think the supplies are not going to be that robust. And we think the demand, which has been spotty, is going to be very consistently strong in 2021 as we reopen. So what is that telling us? It's telling us this is not a bad time to be in the energy situation. And that's why this pays a 6.5% dividend almost. And you've got stocks that don't seem, they have great balance sheets. They keep paying their dividends like Chevron. And it was in the 60 area. I don't know what it's at now. It's at 80. Okay. So yeah, you see, in the 60s, you're getting paid 7% dividend, and they're paying it so far. And now it's all the way up here. So, everybody hates energy, and supposedly Biden's going to kill the energy business. Well, he didn't kill it today, did he? So there you go. Okay, so we went over energy. Crude oil, again, we think has a good future to it because of demand-supply dynamics. And that looks pretty good. Here's another one that we have been putting in the newsletter since early this year, and we were saying the Chinese would come and do their buying before the end of the year, and they certainly did. Up 63% purchases from China in Q3, up 63%. And so in the $8 range, you can see this is where we're getting our buys. This is on a 6-month basis, okay? We've got our buys in the $8 range, right? Buys in the $8 range. And now we're way up here at 11. I'm going to bring the lens back to the 5-year graph. We thought it would go to 11 or, between 10 or 12 once it broke 10. We'll show you why. You see, this is the 12 high from a few years back that we absolutely were involved with there. And then basically it came down here. Our bet was we weren't going to take out 780. So anything in the $8 range looked like a bargain. Once you got above 880 and 9, and then you see the 10 area, the 950 area, that's your breakout. And ever got above 950, it's been a good runner. Now it's getting a bit extended, right? And maybe China's not going to buy as much. So that's how you get a pullback possibly. If you pull back 20 years, you can see sometimes it really goes nuts. You see there's a lot of real estate up here if you get above 12, right? But we think it could be a possibility where it might have trouble in here because it's extended. And if China doesn't do the same buying they were, that's obviously a big buyer leaving the market. And there you go, you got a problem. Okay, a couple of other things in the Freeport McMoran, something we've been in since single digits. Single digits. Let's see what it's trading at today. Up to 20, yeah. See, single digits. Anything under 10 was a bargain. Single digits, right? Bargain. Why? Because it's almost at zero at 5. What, are they going to give away copper and silver for free? So you buy it down here, and you're buying an option. When you buy something like this for $5, you're buying an option. Why? Because you're paying $5. And the only way you lose the $5 is Freeport-McMoRan goes out of business and the common goes to zero. So you really got an option that doesn't expire unless the company expires. That's a great deal. Okay? Now, you know they got silver. You know they got copper. You know China's using copper. You know China's trying to build up Africa. You know we got an infrastructure deal coming. You can see the price of the underlying coppers going from 2 to 250 to 3 to 3 and change. So the underlying commodity is doing great. And the demand for this stuff should be getting bigger, not less. You see the housing boom. So obviously, for us, it was a no-brainer. And obviously, we put that in the newsletter each week. And those who read the newsletter and threw a couple of risk capital coins on the table, they're getting paid today very handsomely. Okay, so that's the copper situation. We also warned a little bit about the housing start stuff. Let's look at some of that so you get an idea. You know, everyone thinks there's unlimited amount of people to buy houses, you know. Well, we thought some of these were getting a little bit rich. You see how it looks like it topped out? So up here, we were thinking people should hedge. What does that mean? If you own the stock, you sell some calls. They're going to be fat because the price is up here. So you sell some calls and at least bring in some cash. And then as it drops down, you can press the call. Did you sell the 90s? Now that it's at 73, maybe you buy that back and sell the 80s. That's called pressing the call down, okay? Also, you could sell a call at 85 or 90 and take the premium and buy a put at 75. Now you've got the right to sell at 75, so you're protected anything under 75. Or if you don't mind adding a little money, you sell the 90 call and buy the 80 put. Now you're protected at 80 until the options expire. So if it wants to drop down, you're still in there. And you're still in the stock, okay? Now, if you sold the call, you've capped it at 90, but right now that doesn't look like a risk because it's at 73. You're 17 bucks away from your strike. And now you've got some insurance on your principal. Let's see, Pulte Homes. Oh, that's Peruvian. Pulte. Pulte. DHM. Probably the same story. Yeah, same story. Topped out at 50. So you sell the 50 calls and buy the 45 put. Now it's at 42. You're protected at 45. And if it starts going back towards 50, you can buy back the call. You don't have to just sit there like Buddha. You can move. So, you know, that's a couple of things you could do there. Here's a couple of other ones that were on our radar in the commodity sector for guys who are looking at some, because, you know, some people think commodities are going to do pretty good. And so if they are, some of these things that are down might go back up. This is coffee. We did very good with this thing early in the year because it went from like 95 to 137. Let's get a 6-month graph up there and we can show you. Yeah. See, that's a big run earlier this year. Yeah, and this was, see, it gets above the line, we're positive. Right now, we're not so positive because that line looks terrible, right? It's coming down. So it needs more work, but this stuff could have a future to it as long as it stays above 100. One last thing before I sign off here. The bond market. This is a Treasury bond for December. And I'll go over TLT. Because this is a big thing. Big thing. These guys are going to be issuing more debt than Carter has liver pills or whatever they used to say, right? All right. So we've been negative on the bond market again because we thought this was a very big blow-off. Let me show you a 20-year graph. I wish I could show you a 50-year graph so you could get the idea how excessive it is. But that looks pretty excessive. Now that looks like a blow-off top, right? Up to 195. That's the March crash. That means interest rates were at their historic lows right there. Does it look like they're going back to their historic lows? No. And that historic low, if you combined it with the 1981, 1982 bottom, which was at 56 or 50 on the bonds. So this thing used to be, this is trading up at 170. In 1982, yields were 16%, and this price was at like 50. So can you see in the last, 30 years there, 40 years, we've gone from the highest interest rates of all time, where people said they would never come down, to the lowest interest rates of all time, and people think they can never go back up. You get a common theme there? So what I'm saying here is that this is a bull market, but it has a lot of real estate to make up if it wants to. And if the GDP is going to be taking off next year, and if inflation is going to get taken off next year, then there's still vulnerability here. And the way people play that, and this is why the banks are going, because yields are rising. And our yield advantage may come back into play, which may help the dollar. See, our yield advantage went away. When we go up here to 195, we lose our yield advantage over the foreign countries. That's why our dollar goes from 104 down to 90. But if we're going to get our yield advantage back, then that also could be helpful to the dollar, which is why maybe the gold and silver are going into the tank a bit. Now, you can see here, peaked up at here, came down here. Now, we did think that down to the 150, 155 range might be the worst case scenario in the short run. So we wouldn't be terribly negative on it right this second, because the time to get negative was up here when we were talking about getting negative. Now it's getting into a little rougher water. But if we break this 155 and things get really cooking, you could go back into here. The risk right now is people are getting ahead of their skis, which means the yield curve has steepened, but it may not stay steepened if the virus is a problem, hospitalizations are a problem, and deaths are a problem. It might not be able to keep its boat legs if the stimulus package comes out skinny or they start fighting again. And then, of course, if the president causes any more havoc in the turnover in the next 8 weeks. So there are some risks out there, and you can see how they could play out differently. That's why you got to be flexible, but try to stay with the trends that are going on. Okay? All right, guys, it's coming to the top of the hour. I certainly gave you your money's worth here. And what I'd like to do is invite you to get the free weekly market update. And in that, we give you an overview on all the different stuff we talked about, some timely stuff on different things we see. And if you have questions, you can ask them simply by shooting us an email. So the way you get on board and you get your free market update each week from the Option Professor is go to the website, optionprofessor.com, OPTION, professor, PROFESSOR.com. Put in your email address, and then each week you'll get it. If you want to email us with questions, more than happy to help you if we could. Again, consult your brokerage firm and your broker and all the people you work with to find your own suitability and all the different factors in any type of trading, see what's right for you, what's not. And again, you could email us at optionprofessor@gmail.com. It's been very good talking to you today. Normally we have guests, but I guess I had enough wind in my sails to give you a full hour, so I hope you did learn something. And again, there's a lot more to learn, which we try to update you on every week. Right now, again, optionprofessor.com signing out, and I'm going to give it back to David, who'll close out the show for today.
All right, thanks, Jim. Yeah, lots of exciting stuff going on in the markets today, so it'll be an interesting week. So just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory or app. You can also go to TimingResearch.com to get access to any of the events as soon as I can get them posted. The archives are always there, available on the site. Also, be sure to watch your email. I have some big events coming up that I'm planning, so I'm going to be announcing stuff about that soon. So thanks everyone for being here. Just want to thank the Option Professor from optionprofessor.com for sharing his knowledge with everyone today. Thanks everyone.